Welcome to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and as I like to remind you each and every week, I'm also the author of a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks, and my company, Taylor Hard Money Advisors, is also in partnership with Chen Lin, who publishes What is Chen Buying? What is Chen Selling? I want to thank each of you for listening to this show, and I would like to invite you also to keep your questions and comments coming to questionsfortaylor@gmail.com. That's questions, the number 4, Taylor@gmail.com. And I would like to invite you to follow me on Twitter. My Twitter handle is JTaylorMedia. I want to thank each of you also for sharing this show with with your friends, and we are once again, with the rise in gold and silver prices, starting to see some additional attention to this show. I want to thank our sponsors for making the show economically viable. Our sponsors for today's show are Novo Resources, Dynacor Gold Mines, and Cornerstone Capital. I've titled today's show The Swiss National Bank and Gold. Axel Merck and David Wolfin return, and based on demand from a lot of our listeners, J. Michael Oliver is going to be with me. He is the editor of Momentum Structural Analysis. That's really a very excellent technical newsletter that used to be geared solely for major institutions. Now Michael is making his letter available to high net worth individuals, and so you don't have to be a Fortune 500 company any longer to subscribe to Michael's letter. It's an excellent letter. I receive it, and that's why Michael is with me, because I think he has a lot of wisdom to impart. We're going to be talking to Michael in just a minute, but before we do, let me give you an overview of what today's show is about. As I said, we've titled it The Swiss National Bank and Gold. Joining me immediately after Michael, when we come back from our commercial break then, will be Axel Merck. He's the President and Chief Investment Officer of Merck Investments. What I want to find out from Axel are his thoughts on the decisions by the Swiss National Bank not to continue pegging the Swiss franc to the euro, just as the European Union gets set ready to, seemingly, from my perspective at least, destroy the purchasing power of the euro. Well, so it sort of makes sense. The Swiss would want to duck out, but I want to find out what Axel thinks the long-term repercussions of that might be. And also at the start of the year, I heard Axel Merck with Kathleen Hayes on Bloomberg Radio, and he was very bullish on the euro at that time and gold, but very bearish on the dollar. Well, since the start of the year, of course, the dollar has continued to rise very strongly. The euro has fallen sharply. Of course, the gold is doing very well. So that part of what he was projecting has turned out well. But want to get his views now to find out, how he's feeling about things. I think part of the premise was Axel believed that the U.S. would definitely have to start quantitative easing 5 or quantitative easing infinite, perhaps. Anyway, those are some of the things we want to talk to Axel about. Then towards the end of today's show, David Wolfin, he's the president and CEO of Avino Silver and Gold Mines, will be joining me. It looks to me as if gold and silver may have bottomed out, and we're going to try to get our Michael Oliver's view on that. But it looks like that may be the case. We may be on to a resumption of the secular bull market, perhaps. At least I hope that's not just wishful thinking on my part. But if that's true, then companies like Avino Silver and Gold, it's a company that's managed to make a nice profit even in a horrible market. At the same time, they're gearing up, increasing production of silver and gold. So it would stand to reason that Avino should be in a very sweet spot to deliver some nice profits for its shareholders. Anyway, we'll be talking to David Wolfin towards the end of today's show. Well, let's, though, turn now to Michael Oliver, who's joined me, and thank you, Michael, for being with me today.
Well, thank you, Jay, for letting me be on. Thank you.
Well, it's always good to talk to you. I must say that your missives come through fast and furious in these markets, turbulent markets, and the insights are, I think, very unique. I like unique insights, not the ones that you pay nothing for, the ones you get on CNBC, and as they say, you get what you pay for. But I would like to maybe before I just ask you a couple of things about some of my favorite markets, I'd like to ask you or just tell our listeners that the best place to go to follow Michael and to sign up for his service is OliverMSA.com. Oliver, OLIVERM as in Mary, S as in Sam, A as in Albert.com. That's the place to go, right? Is that right, Michael?
Right. That's correct, Jay. Yes.
Okay, good. Well, I would encourage my listeners to visit that site and to consider Michael's work. Let's talk. We just have a few minutes, Michael, unfortunately, and we're going to get you back sometime soon when we have a little more time. But I did want to get you in today because of some of the important things you've been saying about some of my favorite markets and some of the favorite markets on this show, namely gold. On your January 13th missive, you put out a letter to your, well, that was on January 13th. You talked about $1,300 gold. Why do you see 1,300 as being such a very important resistance level? And as I take it, you kind of see the need to scale over that to really tell us that we're on to something higher up in the price of gold. Is it simply a lucky 13, or is there some barrier or some momentum or structural thing that you're seeing?
There's actually many reasons for between 1,280 and 1,300 to be what I consider to be the last hurdle. As gold broke through the 1180 lows of 2013, it broke through in November of this year, got to 1140, which was the MSA target for the low. We turned back up, and in the process of that upturn, we crossed several layers that I thought were important. And each time we'd cross one, gold would be propelled upward another $50 or so. But the major hurdle, as measured by various momentum factors that I analyze, annual momentum, quarterly momentum, and also there's some price reason for 1,300 to be a barrier. I will say this, though, and there is a report I put out on the 13th, as you said, that shows the charts and the rationale for that. So if your listeners would like to sample that to look at it, they can simply contact me on the site. But so it's a multiple reasons around the 1,300 level, and I'm of the opinion that if you can credibly close out a week out above there. Now, we've been as high as 1308, I believe, this week or last week. Pull back into the 1270s, and now we're in the 1290s again. So it's holding firm. But this is a resistance level, particularly on a price chart via parallel channel analysis, that we've hit 4 times now. Now, if you lean into a plywood door with your shoulder to break through it, and you're persistent at it, pretty soon you're going to go through it. Yeah. And just on a price chart basis, without all the sophisticated momentum work, I can define this level as a barrier that if you can get through it, there should be a whoosh. Now, the other question is, well, why minimal next target of 1550?
Yes.
There are some price reasons for that, but the primary reason is, again, the price channel analysis. There was a broad channel that gold was in 2012, late 2011, 12, and early 2013 that was slightly downtrending. And when we punched through the bottom of that channel, it was like we opened the guts up of the market and it collapsed. Well, that channel bottom is now resistance, but if you can get back inside that channel, you go into channel top, I'm pretty sure. It's around 1550. I've also done some other work, though, that suggests that if that is achieved this year, and achieved, let's say, in the first half, you could see mid-1600s this year as well. That's based on a strictly annual momentum reason. But for right now, let's just focus on the 1300 level. It is creating some resistance for the last 2 weeks, but we're dealing with it. The market's not folding. And I think if we can close out a week solidly above 1300, not 50 cents or so, but something credible, I think you can pretty much say, okay, that hurdle's crossed, it's open field running. And I think there could be a vacuum effect above the 1300 level, where the rush on the upside, instead of layered, could be pretty sudden.
Well, that's interesting. It certainly runs counter to a report I saw today from, I didn't really have a chance to read it, but reading the headlines from Goldman Sachs is calling for $1,000 gold. But that's what makes it market, isn't it, Michael? It's different ideas.
1800.
What's that?
Where were they when it was 1800? I'm sure they weren't calling for 1200. So
Yeah, that's a good point. Well, anyway, what really made my heart leap for joy was another report that you wrote. Actually, I think more recently, and I don't have it right in front of me, but you're talking about you're turning quite bullish on the shares, more so on the shares than on the bullion. What's the rationale for that?
Well, it's a technical rationale. I mean, there's sort of a gut level fundamental reason too. Basically, the miners got nuked off the page in price, just historical prices. They look like tech stocks at 2002. The difference being that while some technology companies can go out of business because they get supplanted by a higher graded technology, gold miners aren't going out of business. I mean, the industry is not. It's the second oldest profession in the world. And it got nuked. The price was off the page. It just wasn't going to zero. So with that sort of common sense, you look at it and say, okay, is there a technical reason? And there were multiple technical reasons to assume, one, that for instance, I watch XAU, but also GDX, which is an ETF of, the upper tier gold miners. And I'm not picking on any particular one. They're all, I basically think gold miners are the place to be, not bullion this time, which is a sharp reversal of the last 10 years, where it was disadvantageous to own the gold miners. I think the tables have turned. It's a technical assessment based on the relationship between the pricing of, I use the XAU in this case, against bullion. I see a turn in the spread relationship that now favors the miners. If you'll notice any given day that gold's up 1%, you'll see the GDX is up 2 or 3, and it is not a double ETF. So you're getting a lot more bang for the buck, and I think you'll continue to. So that's the rationale for that.
Yeah, and in your chart on that same missive, you passed along some very interesting senior mining company charts, and there were some that were distinctly breakouts and some that hadn't done too well yet. I don't know if you'd care to mention any numbers.
Frankly, I don't have it in front of me, and
as I recall, one of them was gold.
I try to be ignorant of specific gold.
Okay.
No, seriously, I do. I respect them all. It's fine, but I know they have their differences, and there's other folks that handle that job well. Analyzing the intricacies of each company. It's just a fact in any given sector, whether it's gold miners or pharmaceuticals, the symbols within the sector will vary in terms of their performance. You may have a couple of years where, American Barrick will outperform, and then a couple of years it won't outperform and it'll underperform. These things happen. Markets breathe, and relative performance trends breathe relative to, in this case, the mean of the gold mining index, let's say.
That's right. Well, I would just tell our listeners, though, Michael, that I found them very valuable in terms of my own interest to see a breakout in some of them and then others that haven't. I think it's valuable information. And really, what makes you valuable, of course, is that you let the language of the markets do your talking, realizing humbly that the markets are much more intelligent than any one human being, including Michael Oliver. And Michael, I can tell you, my listeners, is a pretty bright guy. But we know that, don't we, Michael? That the collective wisdom of markets is smarter than any individual or group of individuals. If we could only get the Federal Reserve to understand that, we might be in better shape.
They'll be taught their lesson by nature, so I'm not worried about that. Natural force. Yeah. The other thing you might want to point out is silver.
Yes, I would like you to comment on
silver. The situation is looking very interesting. The ratio, or not the ratio, these divide the number of ounces of silver to purchase an ounce of gold. We were at a point where it was 30 ounces back in 2011 of silver to buy 1 ounce of gold. And recently it rose to the upper 70s. So silver is losing its value relative to gold. However, I think I analyzed the spread relationship intricately, and it looks to me like if silver will firm such that it only takes about 68 or 69 ounces of silver to buy 1 ounce of gold, at that point a trend has changed. And I think from that point going forward, you will see silver be stronger than gold. So I would focus, gold people should focus heavily on gold, but it's not the primary vehicle. I think that gold miners are a better place to be based on what gold does. And I think the silver market is likely to be stronger than gold as well, assuming that gold is going to breach this 1,300 and go on up. I think those are the two better places to be.
Again, folks, it's Oliver MSA. That's Oliver, M as in Michael, S as in Sarah, A as in Albert.com. Go there, and Michael said that you will send them a sample, Michael, of your gold.
I'll send that recent gold report, for example, yes.
Great, that would be really good. Well, there's so much more to talk to you about, so we want to talk to you again sometime in the near future.
Thank you,
So
Jay.
thank you very much for being with us.
Bye-bye.